Imagine waking up to find your entire life savings frozen and your bank account balance reading zero. This is the reality of the Yotta collapse, where 85,000 everyday people lost access to $109 million overnight. You probably think your money is safe behind the shield of FDIC insurance, but this is the day FDIC insurance failed, exposing a loophole that could wipe out your savings next. It started on a random Tuesday in May. Tens of thousands of Americans opened their phones to check their savings. Instead of their account balance, they saw an error message. They tried to transfer money to pay rent. The transaction was declined. They tried to buy groceries, but their cards did not work. These were not risky crypto investors or day traders chasing hype. These were teachers, single mothers, and retirees. They were people who did everything right. They saved their hard-earned money in what they believed was a secure government-backed account. But suddenly, their money was gone.
And nobody could tell them when they would get it back. To understand how this nightmare happened, we have to look at Yotta. Yotta was a popular financial technology app launched in 2020. Its pitch was brilliant and simple. Save money and win prizes. For every $10 you deposited into a weekly lottery, the prizes ranged from a few cents to $1 million. It turned saving money into a game. It was incredibly successful, attracting tens of millions of dollars in deposits. But Yotta was not actually a bank, it was a tech startup. To reassure users that their money was safe, Yotta put a massive badge on its website. It promised that all deposits were FDIC insured up to $250,000. This badge gave users peace of mind. It made them feel as safe with Chase or Wells Fargo. But when the system broke, that promise turned out to be an illusion. When angry users called the FDIC, they were met with a shocking response. The government could not help them. The insurance policy did not apply. Behind the sleek screens of your favorite financial apps lies a chaotic web of middlemen. To understand the diagnosis of this collapse, we have to look at the hidden plumbing of the banking system. This plumbing is where the money vanished. And it all comes down to a structural flaw that most savers do not even know exists. Think of a fintech app like a travel booking website. You do not actually fly with the booking site. You fly with the airline. In this case, Yotta was just the booking website. The actual airline, where the money was supposed to sit, was a real bank called Evolve Bank and Trust. It is a member of the FDIC, meaning it has federal protection. But there was a problem. The booking website and the airline did not talk to each other directly. They needed a middleman to handle the logistics. They needed a software program to route the money and keep track of who owned what. That middleman was a startup company called Synapse. Synapse acted like the baggage handling system at the airport. For years, this system worked perfectly. You deposited money into Yotta, Synapse routed it, and Evolve Bank held it. But behind the scenes, a war was brewing. Synapse and Evolve Bank over fees and reconciliation records. They accused each other of mismanaging funds and losing track of balances. Then, in May 2024, Synapse, that was bad enough. But what happened next was worse. When Synapse collapsed, they shut down their servers. Suddenly, the baggage handling system was turned off. Evolve Bank looked at the vault and saw millions of dollars. But they did not have the database to show which belonged to which Yotta customer. The master spreadsheet that tracked everyone's savings was broken. And this is where it gets interesting. Evolve Bank decided to freeze all customer withdrawals. They argued that if they allowed people to withdraw money without a clean ledger, they might pay out the wrong amounts. They could run out of cash before everyone got their share. So they locked the doors. 85,000 depositors were locked out of their own money. Now, here is the part that changes everything. Step in and pay the depositors. After all, Yotta promised that the money was FDIC insured. The answer lies in a massive regulatory loophole. FDIC insurance only triggers a licensed bank must fail. If Evolve Bank and Trust had gone out of business, the government would have stepped in. They would have paid every depositor up to $250,000 within days. Did not fail. Evolve Bank was perfectly healthy and open for business. Yotta did not fail either. It was the middleman, Synapse, that went bankrupt. Because Synapse was a tech company, it had no FDIC protection. The FDIC has no legal authority to intervene in a dispute between a healthy bank and a bankrupt middleman. They cannot step in to fix a broken spreadsheet. The insurance policy was completely useless. The safety net that millions of Americans rely on had failed them. This is the ultimate illusion. Your money is only insured against the failure of the bank itself. It is not insured against the failure of the technology that connects you to the bank. If the middleman loses the records, your money is effectively gone, and the government will not bail you out. So what would you do if your savings were locked tomorrow? Fortunately, you do not have to be a victim of this loophole. There is a clear cure to protect your money from the next fintech collapse. By changing how you store your cash, you can ensure your funds are truly safe. It starts with a simple rule that everyone must follow. It is the direct relationship rule. Stop using middleman apps for your core savings. If you use a fintech app for pocket change or lottery games, that is fine. Your emergency fund, your rent money, and your life savings do not belong there. You must hold these funds in an account where you have a direct relationship with a licensed bank. Your name must be directly on the bank's ledger. To do this, you must look out for the phrase FBO. FBO stands for benefit of. Many fintech apps pool all user funds into a single giant account at a partner bank. The bank does not see you as an individual customer. They only see the fintech company. If the fintech company goes bankrupt, your funds are trapped. Always ask if your account has an registered in your name at the actual bank. The step is diversification. Never keep all your cash in one place, especially not in a digital startup. Spread your savings across at least 2 independent established banks. Choose institutions that have been around for decades and have physical branches. If one bank has a technology outage or a temporary freeze, you still have access to cash at the other. It is the ultimate insurance policy. Finally, do not be seduced by high yields that sound too good to be true. If an app offers double the interest rate through games or prizes, they are taking risks behind the scenes. They are lending your money to speculative projects or using complex financial routing. In finance, there is no free lunch. Higher rewards always come with hidden risks. The Yotta collapse is a stark warning for the digital age. Convenience is a trap if you do not understand the underlying system. If you do not know exactly where your money is, you do not truly own it. Make sure your savings are protected, not pretty apps. The man who kept his wealth in a secure vault slept soundly, while the one who chased high yields struggled. This has been Peak Capital. We have another story next week.